Chapter 14. Using Financial Information in Accounting. Summary with real-world examples. Accounting is the backbone of financial decision-making in any organization, providing a structured way to record, analyze, and report financial activities. Whether it's a multinational corporation like Apple, a nonprofit like the Red Cross, or a local coffee shop, accounting helps stakeholders understand financial health and performance. The chapter distinguishes between managerial accounting, used internally for strategic decisions, and financial accounting, which produces standardized reports for external users such as investors, lenders, and regulators. For example, Tesla's annual report includes a balance sheet, income statement, and statement of cash flows, all prepared according to GAAP and overseen by the FASB. The roles of public accountants, such as those at Deloitte or PwC, include auditing and consulting for multiple clients, while private accountants work within a single organization like Coca-Cola, managing internal financial records and systems. The Sarbanes-Oxley Act, SOX, passed in response to scandals like Enron and WorldCom, introduced stricter regulations to restore investor confidence. It mandates executive certification of financial statements, enhanced internal controls, and limits on consulting services by auditors to prevent conflicts of interest. The chapter explains the accounting cycle, beginning with transactions and ending with financial reports, all based on the accounting equation: assets equals liabilities plus owner's equity. For instance, if a startup like Blue Bottle Coffee invests $10,000 and borrows another $10,000, its assets total $20,000, balanced by liabilities and equity. This double-entry bookkeeping ensures accuracy and transparency. The balance sheet provides a snapshot of a company's financial position. Assets are categorized as current, e.g., cash, inventory, fixed, e.g., machinery, and intangible, e.g., patents. Liabilities include short-term debts like accounts payable and long-term obligations like loans. Owner's equity reflects investments and retained earnings. Amazon, for example, reinvests much of its profit to fuel growth. The income statement shows profitability by detailing revenues, expenses, and net income. For instance, Nike reports gross sales, subtracts returns and discounts, and calculates net profit after operating expenses. The statement of cash flows breaks down cash movement into operating, investing, and financing activities, critical for understanding liquidity. A company like Netflix uses this to show how subscription revenue supports content investment and debt repayment. To evaluate performance, the chapter introduces financial ratios. Liquidity ratios like the current ratio help creditors assess short-term solvency. Profitability ratios such as return on equity, ROE, and earnings per share, EPS, are key for investors. Microsoft's high ROE signals efficient use of shareholder funds. Activity ratios like inventory turnover show how quickly products are sold, vital for retailers like Walmart. Debt-to-equity ratios reveal how much a company relies on borrowed funds, a concern for firms with high leverage like Delta Airlines. Finally, the chapter highlights trends reshaping accounting, including cloud-based services, automation, and staffing challenges. Platforms like QuickBooks Online and Xero allow small businesses to manage finances remotely, while automation tools streamline audits and reporting. As technology evolves, firms like EY are shifting toward advisory roles, helping clients navigate complex financial landscapes.